Hello students, our first unit now, financial system. Structure of financial system, the overall structure of financial system we will see today, and the meaning and definitions etc. we'll see in it. So, the financial system. A financial system functions as an intermediary between the savers and investors. It facilitates the flow of funds from the areas of surplus to the areas of deficit. It is concerned about the money, credit, and finance. A financial system may be defined as a set of institutions, instruments, and markets which promotes savings and channelize them to their most effective use. It consists of individuals, savers, intermediaries, markets, and users of savings, that is investors. Now, this chart is just representing the components, main parts of the financial system. There are mainly these components, there are main four parts, namely financial institutions, financial markets, financial instruments, and financial services. One by one, we'll just eye over this in detail. We will discuss the same in future. Okay. The first one is the financial institutions. The financial institutions means the money institutions. Finance means money. Money institutions, particularly, these institutions are engaged in money, particularly, that is, they are banking and non banking institutions. Banking, purely money, that is, we find in the banking institutions there are two types further: commercial banks and cooperative banks. Commercial banks are those which are registered with the Reserve Bank of India as well. They are the public sector banks. They are also called as the private sector banks. They are also regional rural banks, RRBs, and foreign banks. All these banks which are doing the businesses of accepting deposits and lending money, as you have learned, they have to take the registration or the permission registration of Reserve Bank of India and to follow the Reserve Bank of India's rules and regulations. Similarly, cooperative banks also have to register with the Reserve Bank of India. Along with, they are also registering with the Cooperative Act. They are following the rules and regulations of the Cooperative Act, as well as they also have to follow the rules and regulations of the Reserve Bank. Now, this non-banking financial institutions. These are also the financial institutions which are further divided into two types: one, organized financial institutions, and second is unorganized financial institutions. Organized financial institutions are those institutions which are which are which are registered, or which are having a control of the you see authorities of the government. The government authorities are controlling and organizing the functions of such financial institutions. Like Reserve Bank of India is the authority which controls whole of the banking sector. All the commercial and cooperative banks are being organized, managed accordingly by the Reserve Bank of India, and they fall under the category organized financial institutions. Whereas the secondly, unorganized financial institutions are those institutions which are not organized, which are not controlled by the government authorities. They do the work on their own. They are not bothered with the government rules and regulations, and therefore they are called as unorganized. But still, in our country, India is a vast country where both these organized financial institutions as well as non-organization and organized financial institutions are present. The examples of non-organized financial institutions, we see the pawnbrokers are there, and money lenders are there, and also some local bankers are there. Without registration, these concerns are doing the business of lending money and at the exorbitant higher rate of interest. They don't have the control of Reserve Bank of India over, and they don't have the regulations to follow. So therefore, they are called as unorganized financial institutions. Now, coming to the next component is financial markets. Financial markets mainly are of two types. One is money market, and second is a capital market. See, money market is one which deals in money, immediate money, or you can say short-term money. The money transactions for less than 1 year, that is 365 days, all those transactions fall in the category of money market. On the other hand, capital market is one which is a financial, which is a market for the long term financial needs. Now here money market includes the instruments like call money markets are there, treasury bills are there, uh, commercial bills are there. All these instruments are there which are there in the money market. Whereas in the capital market is further divided into various parts like primary market, secondary market, derivative market session, primary market for the new issue market, secondary market for the existing shares and debentures market, whereas derivatives is for the futures, the hedging of the risk market, that is buying and selling of futures and options. We'll see that in later in detail. Now, coming to the third component of a financial system, that is a financial instruments. Financial instruments are also called as financial assets. So these financial instruments, you can see, are of different types. Now there again we have divided this into two types. One, firstly, we can say term wise, period wise, there are three types of financial instruments. That is short term instruments, medium term instruments, and long term instruments. Whereas type wise, there are again three types of instruments, securities, like primary securities, secondary securities, and innovative instruments. Now, coming to the fourth part, that is the financial services, fund based and fee based. There are two types again in the financial services. One is a fund based, second is a fee based. Now we'll see the fund based. Fund based means various services which fall like leasing and finance, hire purchase, factoring, etc. All these comes under the fund based services, whereas fee based services includes merchant banking, credit rating, mergers, portfolio investors, mutual funds, and all those, they come under the category of fee based services. Now, financial institutions. Financial institutions are the business organizations dealing in the financial resources. They collect resources by accepting deposits from individuals and institutions, and in turn lend the same to trade, industry, and business. This means financial institutions mobilize savings of savers and give credit or finance to the investors. On the basis of the nature of activities, financial institutions may be classified as one is a banking financial institutions. Now we'll see about what is the banking financial. You already have learned in the last classes what is banking. Banking is accepting deposit for the purpose of lending for the purpose of needy, accepting surplus money from the persons who are having surplus money by way of deposits and lending the same to the needy people, and for the further economic development. Now here in this, banking institutions mobilize the savings of the people. They provide a mechanism for the smooth exchange of goods and services. Money economy, we say. They extend credit while lending money. They not only supply credit but also create credit. Now, coming to the second type, that is non banking financial institutions. The non banking financial institutions also mobilize financial resources directly or indirectly from the people. They lend funds but do not create credit. Companies like Life Insurance Corporation, LIC, General Insurance Corporation, GIC, UTI, that is Unit Trust of India, development financial institutions, etc., are the are coming under these financial institutions. Now, next is non-banking financial institutions can be categorized as investment companies, housing companies, leasing companies, hire purchase companies, specialized financial institutions, etc. Financial markets. Now we'll study what is financial market. You see, you know what is market? Market is a place where the things are being bought and sold. So financial market is a place where the finance is being bought and sold. Here, financial markets are the centers or arrangements that provides or facilitates for the buying and selling of financial claims and services. Financial markets exist whenever financial transactions takes place. Yeah. What is this? It is a place where the financial transactions place takes place. Financial transactions include issue of equities, stock by the company, purchase of bonds in the secondary market, deposit of money in the bank account, transfer of funds from the current account to the savings account, etc. Now, classification of markets on the basis of the types of financial claims. The first, it is a debt market. The debt market is a financial market for the fixed claim like debt instruments. Secondly, equity markets. The equity markets is a financial market for the residual claim, that is uh, equity instruments. Now, classification on the basis of maturity of claims. Again, two. First is the money markets, and second is the capital market. What is money market? Money market where the short-term funds are being bought, borrowed, and lent. This is a money market. It deals in the short-term monetary assets with a maturity period of less than 1 year, that is 365 days. Whereas capital market is a market for the long-term funds. This market deals in the long-term claims, securities, and stocks with the maturity period more than 1 year. Now, classification of markets on the basis of a seasoning of claim. Now, there are two again here we can classify like primary markets and secondary markets. These are the parts of stock market. Primary markets are those markets which deal in the new securities. These primary markets are also known as new issue markets. These markets, where the securities are issued for the first time. On the other hand, secondary markets are those markets which deal in existing share equities or existing securities. Existing securities are those securities that have already been issued and are already outstanding. Secondly, secondary market consists of stock exchanges. Of course, stock exchanges, you see, like, BSE, NSE, Bombay Stock Exchange, National Stock Exchange, and many other regional stock exchanges are there, which are functioning, which do the business of, which provide services for the investors to buy and sell the shares. Now, classification on the basis of structure or arrangement. Organized markets and unorganized markets. Already we have already studied this. The These are the financial markets. Organized markets are those financial markets in which financial transactions takes place within a well-established exchange or a systematic and orderly structure. It is controlled by the governmental authorities existing for the purpose. Unorganized markets. These are the markets in which financial transactions takes place outside the well-established exchange or without systematic and orderly structure or arrangements. The transaction here takes place without any control of the governmental authorities. Now, classification of markets on the basis of timing of delivery. Now, delivery timing, that is, there are again two, cash and forward. Cash market is also called as a forward market. Cash market is also called, sorry, as a spot market. Cash market is the market where the buying and selling of commodities happens, or stocks are sold for cash and delivered immediately after the purchase or sale of commodities or securities. Whereas, secondly, forward or the future markets are those where the participants buy and sell the stocks and commodities, contracts, and the delivery of commodities or securities occurs at a predetermined time in future. Other types of financial markets include a foreign exchange market. What is a foreign exchange market? Foreign exchange market is simply defined as a market in which one country's currency is traded for another country's currency. It is a market for purchase and sale of foreign currencies. Derivative market. As we said, derivatives, I have already told you, derivatives market means it is a market for the products which you can hedge your risk by buying it for the future buying. It's also in the it's available in the stock market. These are the products available in the stock market, derivative market products like futures and options. Options in the sense options, buy options, put and call options. We will see those in detail here. Firstly, you should understand first that derivative markets are the most modern financial instruments in the hedging risk. You know, the individuals and firms who wish to avoid or reduce the risk can deal with the others who are willing to accept the risk for the price. The common place where such transactions takes place is called a derivative market. Financial instruments. This second time. Financial instruments are used for raising resources from the corporate activities that are used for raising capital through the capital market are known as capital market instruments. For example, equity shares, preference shares, debentures and bonds, etc. That that are used for raising and supplying money in the short term, not exceeding 1 year, though various securities are called money market instruments. Through examples of money market instruments, I'm going to give you further in detail in a separate topic. This is because it is very important question all the time being asked by the University of Chennamma, Rani Chennamma University. So, which are the various instruments that are being used in the money market? Okay. Now here, for example, just quoted few for treasury bills, gilt-edge securities, state government and public sector instruments, commercial papers and commercial bills, etc. Financial services now. So these are the services, the development of the sophisticated and the mature financial services in the country, especially after the early 90s, lead to the emergence of a new sector. This new sector is known as financial service sector. Its objective is to intermediate and facilitate financial transactions of individuals and institutional investors. The financial institutions and financial markets help the financial system through financial instruments. Now, the financial services also includes all the activities concerned with the transformation of savings into investments. Important financial services includes leasing finance, hire purchase, installment payment system, merchant banking, for forfeiting and factoring, etc. Thank you. Okay, now we have seen this video. In the next video, we will see in detail the various instruments again used practically in the money market as well as the capital market. Thank you. Thank you, students.